Hello and welcome to the November monthly update. Before I get on with things, a bit of a disclaimer. Nothing I say today should be taken as personalized financial advice. I do not know your specific circumstances, so today is for information only. The information and opinions I share with you today are accurate to the best of my knowledge, but I cannot take any warranties because I'm reliant on third-party sources. If you decide to act upon the information or the opinions that you hear today, you will be responsible for the financial outcomes. You cannot hold me or Saturn Advice liable for any unwanted financial outcomes. So what's been happening? Firstly, COVID. So we are still under restriction. I'm in Auckland, so still under level 3, but we are definitely moving forward. The government has announced that the country will be moving on to the new traffic light system early next month. So we're getting there, but there's been quite a bit of debate on to what the government should have done and what it should do going forward. Without getting into that, I would like to point out that we are less restricted than we were, say, 2 months ago. So we are definitely moving forward. And the most important part is we don't have to backtrack once we do move forward. The reason I say that is while globally, most of the countries are definitely moving past COVID, there seems to be a bit of a resurgence in cases, hospitalizations, and deaths, particularly in parts of Europe. Which is causing reintroduction of restriction. The Austrian government has announced a full-blown lockdown, and Germany has indicated it may follow suit. And there are protests happening across Europe as a result of the reintroduction of these restrictions. So I'm really keenly watching. If that becomes a widespread trend, it could hamper the economic recovery that we have seen over the recent months. And that may not be a good thing for the financial markets. Now, on the financial markets front, New Zealand share market hasn't really done much over the past few weeks. I mean, it's a really small share market. It's dominated by a handful of big names. If one or two of those big names aren't really moving forward or having a bad run, then the whole market sort of gets dragged. And that's the classic case for diversification. Quite a few of the new clients that I talk to who have been investing, they end up with, in most cases, they have just, New Zealand shares. Some might have a bit of Australian as well. But the bottom line is if you're just, focusing on one geographic region, you're limiting yourself to just that one country. So kind of like, keeping all your eggs in one basket. So as an advice business, what we try to do is spread our clients' assets across not just different industries and sectors, but also different geographic regions. And, the last few weeks are, a case and example, because while New Zealand share market just moved sideways, the global markets actually had a decent run. The markets were down in September, but late October and November has been pretty strong. So they're back up to near record levels. Going forward, we are heading into the holiday season. Typically, again, it might be different this time around, but typically holiday season is positive for share markets. Primary reason for that is a higher consumer spending. So retail businesses benefit from more business, and also companies in consumer discretionary sector benefit. More business results in higher earnings, and higher earnings means share price appreciation. And that's the bottom line. If a business can increase their earnings, their share prices will go up. And the classic example of that is the technology sector, which, despite a lot of criticism that their valuations are lofty and pretty high relative to rest of the market, they keep coming out with the earnings announcement which beat market expectations and hence justify their valuations and further valuation appreciation. So as long as they can do that, the future looks good for them. But again, if they do end up missing earnings expectations, the share price will pull back. Another major concern that I have come across from discussions with clients is what they say, runaway inflation. I simply say high inflation. Firstly, as I've mentioned that in some of my previous commentaries, inflation is not a villain. We need inflation for sustainable growth. So having inflation is good. What must be avoided is out of control inflation, which is what they are referring to, runaway. So right now, inflation is really high, historically high. At least, hasn't been this high over the past 10 odd years, if not more. But I do not think that we are going back to runaway inflation or out of control inflation period, which was, the 80s, 90s, or even 70s, when, inflation was high teens or up to 20%. The reason I believe that's not happening is central banks are actively progressing on tapering. So what is tapering? Tapering is moving away from the extraordinary policy support they implemented when COVID struck, which was called quantitative easing, which was bond purchases, which resulted in flooding the economy with money. So when they're winding that back, i.e. tapering, they are going to reduce the money supply, which should put a handbrake on inflation. Another factor that is to be considered is interest rates. Interest rates are at historical low levels. Some central banks have already started raising interest rates. RBNZ, for example, has already raised the OCR once. But most central banks globally are expected to raise interest rates over the next 12 months. So raising interest rates will also result in a pullback in the rate of inflation. So I don't think inflation is a major concern at this stage. But raising interest rates as that happens is going to have an impact on asset prices. I've explained this previously, but we'll quickly just say that interest rates and asset valuations are inversely proportional. So if interest rates are going up, that is a down factor for asset valuations. Not in exactly same proportion, but it is a factor that's not going to help asset valuation appreciation. So while interest rates are going up, asset valuations may stagnate, maybe even pull back a little bit, but that depends on how quickly the interest rates are increased. If interest rates are raised in a manner which is expected by the market, then shouldn't be a problem. But if there is an upside shock in the rate at which interest rates are increased, then that could be a bit of a concern for the asset valuations. But important bit is it's really hard to time the market, i.e. you decide whether to go in now or you wait until the market has pulled back a little bit as a result of rising interest rates, and then you go in to ride the wave back up. The more sure shot way of achieving capital growth and accumulating wealth is going in, investing into good, high quality assets, and then staying put, riding the ups and downs of the share market. Eventually, you will come out a winner. So please do get in touch with your financial advisor, or if you don't have one, with a good financial advisor, qualified financial advisor, and they'll be able to address any questions. But if there's a specific topic you would want me to talk about at one of my videos, please do get in touch. My details are right there. Until the next time, take care. Goodbye.